Flexible insurance for long-term care, a study of stated preferences. Aging societies need efficient and flexible systems to finance care for the frail elderly. We study pre-retirees' demand for flexible insurance that can finance informal long-term care by paying income in poor health state instead of reimbursing formal care costs. We collect and analyze stated preferences for this long-term care income product and preferences for informal care. When asked to allocate wealth to a life annuity, a liquid investment, and flexible long-term care insurance, around 75% of our sample of 1,008 pre-retirees choose some long-term care cover. Study participants treat long-term care income insurance as a complement to informal care from their families. Females who expect to rely exclusively on extensive care from family members prefer more cover than similar males. We also find that if long-term care income insurance were available, some healthier seniors would purchase additional longevity insurance using liquid funds otherwise set aside to self-insure long-term care risks. Aging societies need efficient and flexible systems to finance care for the frail elderly. More than half of people now age 65 will need long-term care at some point before they die. At the same time, meeting this need is expensive, with long-term care services consuming more of the financial resources of seniors and their families than other health-related expenses. Since long-term care is so costly to many households, it is surprising that long-term care insurance isn't sold at all in many countries, and even where it is available, few people buy it. So far, research into this puzzle has concluded that the development of markets for long-term care insurance is hampered by two problems. The first problem is the difficulty insurers have appraising the risk of individual purchasers. This difficulty has induced providers to exclude broad group of potential customers. The second problem relates to the structure of the insurance payout. Insurance that reimburses incurred costs of care creates an incentive for families to substitute formal or uninsured care for informal uninsured care, consequently encouraging claims. This paper investigates the second of this problem. We collect evidence of seniors' demand for long-term care insurance that is structured to complement rather than substitute for informal care. Finding ways to support informal long-term care isn't only a concern in countries with a familism culture, but also in the United States, Europe, and Australia, where formal long-term care arrangements are more common. Home-based long-term care is increasingly popular with elderly people and government, alongside calls for institutions that can enable seniors to get care at home are calls for more flexible financial support for informal carers. Informal carers bear costs including lost time, lost earning, and detriment to physical and mental health. They are not reimbursed by typical long-term care insurance and are only partially offset by public carer payments. Here we study demand for an emerging insurance product that can provide flexibility to elderly people and their families as they manage long-term care risks. This long-term care insurance product pays a regular income whenever the insured person needs care, irrespective of the formal care costs they actually incur. We label this long-term care income insurance. Such a product is emerging in the US market and has been envisaged in social care policy discussions in the United Kingdom to complement a proposed lifetime cap on individual contribution to care. A challenge for research into the viability of such new product is the lack of revealed prevalence data. We address this challenge by measuring potential purchasers' interest in long-term care income insurance using the stated preferences of a representative sample of over 1,000 Australian pre-retirees. We collected preferences in a two-stage choice task, followed by a general survey of demographics, health and illnesses, subjective expectation about the need for care, potential sources of care, and a variety of personal characteristics. This comprehensive data collection means we can estimate the effect of participants' anticipated access to informal care and their subjective assessment of long-term care risk on their demand for long-term care income insurance. We incentivize participants to learn about one new and two existing products. A new long-term care income insurance product that exchange a single premium payment for health contingent income benefit, a life annuity, and a liquid investment account. We then asked participants to divide their hypothetical retirement saving between these products in a sequence of choices. These choices identified their preferences for health contingent income from long-term care income insurance, survival contingent income from the life annuity, and liquid wealth. In the first stage of the choice task, participants use a slider to choose how much of their retirement saving they would spend on long-term care income if they also receive an inflation-linked lifetime income from a public pension and a life annuity. The lifetime income rose incrementally over four choice sets as the present life annuity allocation increased and remaining wealth stayed in a liquid investment account. After collecting participant choices at different levels of annuitization, we asked follow-up questions to identify their most preferred mix of income products and liquid health. Results from this stage showed that around 75% of the pre-retirees in our study chose to spend at least some of their retirement saving on long-term care income. In the second stage of the choice task, we measured how access to long-term care income insurance affected participant demand for life annuities and precautionary saving. We collected participant preferences for more liquid wealth versus higher or lower life annuitization in the event that the long-term care income was no longer available. From this task, we find that if people can access a long-term care income product, they are more likely to release precautionary saving and purchase longevity insurance. We collected the data in Australia where long-term care is financed by a combination of public and individual out-of-pocket funding. Unlike the United States, there is no market for long-term care insurance. Eligibility for public funding for care costs for people in their own home or in a residential care facility is determined by an Aged Care Assessment Team or ACAT. The amount of public support is targeted by means testing, as is the case in the United Kingdom and several other OECD countries. The amount of means tested by asset and income, care fees paid out of pocket by care recipient is subject to a lifetime cap of 69.102 Australian dollars. However, the public support doesn't cover basic daily fees, annum for care at home, and around 19,000 Australian dollars per annum for residential fees for additional service accommodation payment, except for full-age pensioners with few financial or housing resources or support for informal care. The Australian setting has several advantages. Thank you.